boatload of passive losses that first year, 10xing it. You gotta make more money, bro. Quick hack. It's kind of up in the air. Hey folks, your rich uncle here. Now we're gonna be quickly going over this quick hack for guys making under $100,000 adjusted gross income or income-wise at your day jobs to save potentially $5,000 off your taxes really simply. For those of you guys making $100,000 to $150,000 adjusted gross income, which is basically your income minus a few standard deductions. So for most of you guys are under that threshold, you can take advantage of this tax benefit where you use up to $25,000 of passive losses to lower your income. So case in example would be a guy making 100 grand. He has $25,000 of passive losses which he got from his real estate investments, or maybe he invested in a real estate syndication that got used a cost segregation to get him a boatload of passive losses that first year. Well, what some of my folks are doing that are in those lower rungs of income is that they are able to use those $25,000 of passive losses to go from $100,000 AGI or adjusted gross income down to $75,000 AGI. That's what they're using those $25,000 of deductions to get them from 100 grand to 75 grand. Now, I don't have the tax brackets right off the top of my head, but that's potentially about a $5,000 tax savings right there. And that's what those passive activity losses are for. And that's something that you definitely should be queuing up your CPA on, making sure they're doing that for you if you have those passive activity losses. Some of you guys are even on the lower end of the income spectrum. Maybe you make $50,000 a year. Well, you can still take advantage of this, and you can drive your adjusted gross income from 50 grand to 25 grand by taking this $25,000 deduction. Or maybe you only have $10,000 of passive losses built up, which, at that point you can go from 50 grand to 40 grand, still sheltering at $10,000 from your taxes there, not paying taxes on that. But then you have to ask the question, right? Like, are you in a lower tax bracket now than in the future? And this is where things get a little tricky and where every situation is different. When you're in the lower tax bracket, only making $50,000 a year, you may elect to forego using this little tax strategy for a future year when you make a little bit more money in the future. All you guys should be trying to work to get that income up, because you can't really do much on savings at some point. You can only save so much money, but you can possibly do more to make money. And I think this is where you hear a lot of financial gurus like Grant Cardone kind of hitting the hammer on making more money, getting your income up, 10xing it. And I'm not totally on that train, but this is in this instance where something's got to give, and in this case it's your income. You got to make more money, bro. You can still do it, but it's kind of up in the air. And this is where kind of we work with people to kind of fine-tune their strategy, because every situation is different. The next question you're probably logically asking is, well, how the heck do I get these passive activity losses? Well, passive activity losses come from passive investments, or one of the best ways we get them is through the depreciation of real estate. So when you own a real estate property, you're able to deduct 1/27th of the value of the building improvement over 27 years. So let's just say the building improvement was $27,000, just to make things really, really easy for myself. So $27,000 divided by 27, I can deduct $1,000 from the property as a paper loss every year. Now, it's gonna take me 27 years to deduct it all off, but this little deduction helps me on my taxes and can help you if you make under $100,000. Now, most of my clients, they make well over $100,000, $200,000, $300,000, and when you make over $150,000, you get phased out of this. So for example, if you make $125,000, you're only going to be able to get half of this little benefit here. But for a lot of my folks that are in that realm of $100,000 or $150,000 or less income wise, this is a great little tip. And these are the little tips that helps you get off the ground, because in the beginning, getting to your first $100,000 net worth, $250,000 net worth, to me, that's the hardest part. Once you've made that, the first, second, third $1 million is the easiest after that. But if you guys have any questions, let me know. If you guys want to learn more about these tax benefits and really the reason why I invest in real estate after all, go to SimplePassiveCashflow.com/tax and make sure sure you're having the conversation with your CPA and attorney. If you guys need a referral, let me know. If you guys need anything else, let me know. Drop a comment in the comment box below and drop a like too. We always appreciate it. And we'll see you guys next time. Bye.